This video will walk you through Chapter 9's flexible budget versus static planning budgets. You can see here I've given you a flexible budget performance report. This is right out of your textbook. And this really will help you understand 90% of what's presented in Chapter 9. Now, just to show you your formula sheet that you get to use, I've given you the outline, not numbers, but I've given you the headings and let you know what columns are subtracted to get the different variances, activity versus revenue and spending variances. This template can help you answer probably 90% of any type of conceptual or definitional questions, and should be able to answer 100% of any calculation questions based on flexible budgets or static budgets. So, the first column is for your planning or static planning budgets. What you want to remember is your static planning budget is prepared before the period begins and is valid for only the planned level activity. So it's only valid if we have 1,000 client visits. As soon as our actual results are not 1,000 client visits, more or less, it's not going to help us. And why is that? Because it can't help, because expenses have both variable and fixed components. Now, if you remember, right, if we think about variable costs, we look at variable costs on a cost per unit basis because it's constant whether the activity level increases or decreases. It's always going to be so much per unit. But when you take the cost per unit times the activity level and get total variable cost dollars, it's going to increase if the activity level increases, and it will decrease if the activity level decreases. So as soon as actual results have different activity levels than what your than what your static planning budget has, you can't compare variances for expenses. However, for fixed cost, since we only analyze fixed costs on a total dollar basis because it remains constant with all activity levels, your static planning budget is excellent if your actual results are comprised mostly of fixed cost. As soon as you have variable expenses and a significant portion of variable expenses, you can't use the static planning budget for spending variances. Also, revenue variances will also be different because it's going to be, what do I charge per client visit? And if my activity level is different in actual results, I can't use it because revenue is not going to be the same. So the first variance here is what we call activity variances, meaning how do I compare in my level activity? Well, we compare that with the flexible budget. So activity variances is the difference. You can see here it's column 2 minus column 1. Column 2 being flexible budget, column 1 being the static planning budget. It's a difference between those two. And when we're talking about revenue, so if we're talking about activity variances, if revenue is positive, if the difference between the two revenues is positive, we have a favorable variance. If the difference in revenue is negative, then you have an unfavorable variance. And why would that be? Well, if we go back to this here, you can see, you can see that my revenue under flexible is $198,000, and it's larger than my planning budget. So the difference, 198 minus 180, is going to give me a positive 18,000, which is favorable. But if I look at expenses, I've got 105,700 in wages under flexible versus 102,000 on my planning. So it's going to give me a positive 3,700. Positive expenses is unfavorable. You want to have negative because that's telling you that your planning budget is actually greater than what your flexible budget shows you. So again here, if we talk about, if I have a positive expenses, that's going to be unfavorable. or the opposite of how revenues are looked at. And if I have a negative difference in my expenses for activity, it's going to be favorable. Then we have revenue and expending variances, and that's where we compare actual results to flexible budget. So it's actual minus flexible, and it's the same outcome. You can see here, my actual subtract my flexible gives me a negative 3,800. Negative 3,800, even though it doesn't show you negative, it would be a negative number, is unfavorable when it deals with revenue. But here I've got 106,900 in expenses versus a flexible budget of 105,700. That gives me a positive 1,200. Positive expense variances is unfavorable because you want your actuals to be less than your flexible budget